Good morning. You're watching Daybreak on Bloomberg Quint Live, and I'm Alex Matthew. First, the headlines this morning. Asian markets are off to a mixed start after a volatile session on Wall Street. Oil prices are trading flat after 7% fall in trade yesterday. The fall in oil prices also aided the rupee, which posted its best single-day gain in over 5 years. The government of Gujarat has decided to waive off power bills in rural areas and for consumers below the poverty line. And sources tell PTI that Yes Bank has recommended the name of board member Brahm Dutt for the post of its new chairman. The post was vacant after Ashok Chawla resigned. Let's talk about the U.S. markets now. The battered Dow Jones closed higher but well off its best levels on Tuesday, staging a rebound from a two-day drop of more than 1,000 points that was sparked by worries about the health of the global economy. Wall Street's focus now shifts to the decision on interest rates from the Federal Reserve, which investors hope will signal a pause in its rate hike plans, at least going forward. Bloomberg's Sue Keenan wraps up that particular session in this report.
U.S. stocks held near a 14-month low in the latest session on Wall Street, where the volatility of the day was not reflected in the close. The major benchmarks were close to unchanged and all in the green. However, oil, New York traded West Texas Intermediate futures stole the show. Futures plunged by as much as 8% intraday, ended down more than 7%, and in extended trading were down near $46 a barrel. It was a combination of economic jitters and surging supplies from U.S. to Russia that has traders concerned. Those close to the matter say there's also the possibility of major funds being forced to liquidate because of the sharp drop in price. In stocks, oil-related stocks were among the biggest losers, with stocks from Exxon and Chesapeake Energy down as much as 3 to 5%. Consumer stocks also took a hit. After the bell, FedEx grabbed the spotlight. It reported an outlook cut. It slashed its profit forecast going forward, and that raised new concerns that global trade may be an issue. It all sets up for a very interesting Wednesday on Wall Street, where investors are waiting the Fed to decide on interest rates. In New York, Sue Keenan, Bloomberg News.
Right, and let's talk about that Fed decision. U.S. President Donald Trump has spent months attacking his own Federal Reserve Chairman, Jerome Powell, accusing him, the former investment banker, of trying to undercut him politically by raising interest rates and slowing down the economy. However, later today, it'll be Powell's turn to respond. Bloomberg's Kathleen Hayes tells you how market analysts are reading the situation and what the possible outcome could be.
Donald Trump saying a rate hike would be a mistake. He says that balance sheet reduction, quantitative tightening, letting that run down, that's taking liquidity out of the stock market. He says Fed should figure it out and not hike. But a lot of people say, look, you're just painting the Fed into a corner. If they hike, which maybe that could hurt growth, then that is the problem, that possibly they're doing it just to show the world that you can't control them, and a pause would be seen as giving in. So with this in mind, let's look at some of the reasons why maybe the Fed should pause. Global stock markets under pressure and a global economy looking weak. Look at China in particular. Geopolitics like the trade war, Brexit, that vote coming up in January. Strong dollar threatens manufacturing in the U.S. U.S. housing market, a very interest-sensitive sector, continues to get weaker. Now, how about the reasons to hike? Well, Bloomberg Economics puts unemployment being low at the top of the list because that's pushing up wages. That's going to boost inflation next year. They say interest rates are still accommodative. Consumers are spending in the holiday season. Confidence still pretty strong. And GDP growth next year is going to remain above potential. So now let's jump into a Bloomberg chart. World interest rate projections work. And what you're going to see over here is it's about 2/3 now, about 65%. That's the chance traders see of this rate hike. Look down here, you can see this is how that's eased a bit over the past couple of months. The odds of no change have come up a bit, but nevertheless, that's still the predominant conclusion. And what about 2019? That's another big question. Will the Fed cut the number of dots it has representing the number of rate hikes next year? In September, it stood very narrowly at a 3 rate hikes consensus. Could that go lower in the light of all these things that are happening in the global economy and global markets?
All right, so a lot to look forward to. Of course, the updates from that Fed meeting will be in towards the end of our day. Before we get to all of that, let's take a check of how Asia is looking. From my perspective, they look a little bit mixed as of now. Most of them have opened up. We're joined live by Bloomberg's Sophie Kamruddin, who will hopefully give us a better idea. Over to you, Sophie. Good morning.
Good morning. Well, midweek, we are seeing Asian stocks trading mixed after a choppy session on Wall Street, and stocks in Japan are bearing the brunt of the losses, extending yesterday's decline, with SoftBank Corp falling as much as 10% on its trading debut, which may have investors question the timing and size of the IPO. Now, tech listings have also fared poorly this year in Hong Kong, adding to the drag on the Hang Seng in 2018. But today, we could see the Hang Seng looking to fluctuate as we have Tencent on the back foot. But we have the likes of financials and consumer stocks gaining ground. But so far, we are seeing the Hang Seng perhaps extend its drop for a fourth straight day. And oil players are also a drag in Hong Kong, as around the region tracking the overnight slump in crude prices, energy weighing the most in Sydney as well. And ahead of the Fed decision, we are seeing the dollar faltering as treasuries continue to rally, seeing the 10-year yield slip below 2.8% earlier for the first time since May. And as China kicks off a three-day economic policy summit, shares on the mainland are opening lower. The Shanghai Composite down about 0.2%. Back to you.
Thanks so much for that, Sophie. Well, let's talk about China and, in fact, its trade with the U.S. The U.S. expects to hold a series of trade talks with China in January, aiming for a preliminary resolution of the issues underpinning their trade war. That's according to U.S. Treasury Secretary Steven Mnuchin, and he said this in an interview with Bloomberg. Bloomberg's Tom McKenzie has all the details in this report.
Steve Mnuchin telling Bloomberg that that is something that they are aiming for on the US side, a verifiable deal or agreement that comes out of the back of this with specific timetables. Now, this was the first time that we've heard details about a planned face-to-face meeting between the US and Chinese sides on the back of this G20 meeting. We know that they've been having telephone conversations, and those talks have continued. And as you've said, Steve Mnuchin indicating that they are planning on having a face-to-face meeting, the two sides, in January. He talked about the fact that the trade deficit was still a concern, but said that's going to be a longer running issue and that they are cognizant of that as well. He was also asked about the case of the Huawei CFO and said that both he and President Trump were unaware that she was going to be detained in Canada as they met President Xi and his team in Buenos Aires at that G20 meeting. But as you say, it's the verifiable elements of this agreement that Steve Mnuchin was stressing in this. Of course, on the Chinese side, we have had steps to address some of the concerns on the back of that G20 meeting, whether it's increasing products, increasing imports of agricultural products from the US, or reducing those auto tariffs on US cars, and of course, fleshing out the intellectual property framework and those sources as well, telling us that China is considering amending its industrial policy around Made in China 2025. But it is all going to be about the verifiable aspects of this deal. We've heard it from Mnuchin, we've also heard it from Wilbur Ross as well.
All right. Well, more on that over the course of the day, and in fact, as we hear more. But for now, let's turn to Agam Vakil, who's joining us with the trade setup for the day in India, and also to tell you what's happening in the futures and options space. Agam, well, what's on your list today?
Well, Alex, I'm going to start with the SGX Nifty, which is trending higher. It's taking cues from the mixed Asian markets at this point in time, but it's higher and inching towards 11,000. That perhaps is a positive today. And should we see more strength come through, well, we're going to see the Nifty take out 11,000 after a really, really long time, perhaps after a few months. But what we saw yesterday was, well, range-bound trade, marginal gains coming through with the Nifty did closing about the 10,900 mark. The mid-cap and the small-cap indices doing better than the benchmark indices. The financials, and by that I mean the banking indices, also advanced in trade, providing a bulk of the support yesterday and bulk of gains. But let's pull up your Nifty Pharma Index that did advance by around nearly 0.8. The one index that was really under severe pressure was the media index, and that was largely on account of the weakness that we saw in Z Entertainment, which came off by around 8%. But moving on in terms of the ADRs, at this point in time, what we're seeing is a lot more activity and buying in ICICI Bank, Dr. Reddy's, Vedanta, and Tata Motors, and among others. Well, marginal weakness in Infosys and Wipro, so not too much to speak for. So all around, it has been a decent day for the ADRs. Now, Again, gross numbers for both institutional segments were very, very small. That means buying and selling was limited. That, of course, explains the limited turnovers, but not too much to speak for here as far as FIs and DIs are concerned. But, well, the Nifty did advance by 20-odd points. Where did some of the contribution come in from? L&T, ICICI Bank, and Reliance Industries. On the losing end, we had weakness in Infosys, Z, and ITC. But let's move on and talk about futures and options. Now, before I move on, I do want to mark the news that SEBI has allowed the weekly Nifty options, and they will be introduced soon. So that could be something that could move the derivatives markets. Of course, they will be introduced, and the dates still have to come out before now. The SEBI approval for the exchanges is in place, and that perhaps could be good news for those who want to trade in the weekly options for the Nifty 50. So far, we only have those for the Bank Nifty. So coming down to the futures, well, we do have, again, very little change in open interest, or for that matter, the underlying for the futures. And the Nifty futures too, well, they did, Nifty Bank futures, pardon me, they did see about another 4% addition in open interest. So there you have it. There's some longs coming in. In terms of the changes in open interest yesterday, what we saw was 10,900, looking at writing, the 10,900 put and the 10,900 call as well. A lot of unwinding coming through at around the 10,700 and 10,800 levels, both in terms of calls as well as puts. The range really hasn't changed as far as your Nifty is concerned, at least in the near term. What we've seen is 10,500 on the lower end. However, we do have considerable increase in open interest for the 10,800 put, and that's where you could see some amount of support come in. Of course, on the higher end, it is 11,000, and should we see the Nifty move by 11,000, well, we're likely to see a change in the range too. But let's move on and talk about your VIX, and well, okay, this remains relatively unchanged at 14.5. Again, when it comes to the PCR, no real change. So the Nifty put call ratio at around 1.58, the Bank Nifty put call ratio at 1.51. And moving on to talking about stocks, so we have Aegean Financial. What a day it's turned out to be, with longs coming in, 14% added in open interest. And we're also taking a look at Chennai Petro, which also advanced in trade, and about 20% added there, and open interest towards longs, and Berger Paints, longs there as well. So, well, on the whole, Alex, it's turned out to be a good day of trade for the broader markets. Again, we're going to keep an eye on what the global cues can do for our own markets.
Definitely. You know, a lot of the viewers have taken note of your new avatar today with your spectacles, and they say that they like what they see. All right, with that, let's move on to the news on commodities. Yash Upadhyay is joining us to tell us all the updates there. Yash, I'm guessing you're going to start with oil because that's the big mover.
That's right, Alex. Morning to you. So crude oil prices, they crashed to their lowest level since October 2017 on the back of reports of a big jump in U.S. inventories and forecasts of a record shale output, stoking concerns over global supply glut. Brent crude prices, they ended the day more than 5.5% lower on Tuesday to settle around the $56.3 per barrel mark after the U.S. government report on Monday forecasted a surge in shale oil production. Additionally, prices came under further pressure later on in the day after the American Petroleum Institute reported a jump of nearly 3.5 million barrels last week in U.S. stockpiles. Weakness continues in the base metal names, with almost all of the base metals barring lead ending the day lower on the London Metal Exchange. Copper fell more than 2.5% on Tuesday, closing at its lowest level since September 17. Aluminum prices, they ended by almost 1% lower on the back of rising inventory levels, which hit the highest mark since May 24th. Tin and nickel were the other two big losers, falling anywhere between 1 to 1.4% each. On the other hand, we continue to see strength in gold prices, with spot gold prices climbing for a second consecutive day, tracking the weakness in dollars as in the US dollar as traders await on the sidelines ahead of the US Fed meet.
All right. Thanks so much for that, Yash. Sticking with crude. Now, crude, as you know, is mired in a bear market amid growing skepticism that the OPEC countries and its allies' production cuts will not be deep enough to prevent a surplus in 2019, and that's why you've seen the big move in the recent past. But what is the sentiment really surrounding oil at $50 a barrel? Let's find out from Bill Baruch, who is president of Blue Line Futures. He's in conversation with Bloomberg.
There is some support coming down at 47.74. I would imagine that holds this week just as long as we don't see a build in inventories. One thing I do want to point out is last week on Thursday, crude ripped higher and did fail for the lower high for the fourth time below major three-star resistance is what I'm calling it against for my clients. That was on news that there was a draw in Cushing. I think it was about 800,000 barrels for what is coming into this week. If that does not meet that expectation, we could probably slip below 47.74 very quickly. Also, I'm watching the Fed very closely heading into tomorrow. Are they going to encourage more of a risk-on sentiment? Is the equity market going to rally? I would expect crude to follow, because with that, you're going to get a weaker dollar. So there's a lot of moving parts this week, but right now, crude is very unenthusiastic, and I think rallies right now are just, they're very short-lived.
Yeah. How much attention is being paid to the equity market sentiment, Bill? It's not normally the way it works, but it does seem as if traders are paying much more attention to other asset classes and ones they wouldn't normally look at.
Well, you know, the equities, too, you're getting rallies. There's in the S&P, for instance, is being sold into the first time it hits maybe first resistance or second resistance. That happened again this morning. Crude is just the same thing. And so yesterday, when we saw the S&P and broader equity markets take a bloodbath, crude was a casualty. It was one of the first casualties really to go as well. I mean, crude has been crushed over the past 2 months, and there's not a lot of sentiment. Buyers are few and far down here at $50. You have some people holding back and trying to buy, but look at the volume here below $50. There's not very many buyers stepping up, and that's where the difficulty is. No one's taking that bet here.
All right, so that's the perspective on how oil looks on the charts, and perhaps for some of those traders there, from the perspective of India, it's a lot more important with regard to the state of the economy, because it rapidly changes the scenario with regard to imports, and that was reflected in the rupee and the dollar yesterday, in the movement therein. If you look at this is the last 3 days worth of movement. It ended, in fact, at 70.44 against the US dollar. The big intraday move that you see on the chart is the highest intraday move that you can see on the downside in 5 years. So that's significant. You should watch out for the currency today, and you should also watch out for the bond yields, because the RBI has increased the quantum of open market operations as it looks to address the liquidity concerns that you've probably heard about. The central bank will now conduct 2 open market operation purchases of 15,000 crore rupees each in December. That's 10,000 crore rupees more than had earlier been planned. This will be followed up with 5 auctions in January, each worth 10,000 crore rupees. Now, the RBI had reassured the market of elevated level of bond purchases until March to address any liquidity constraint in the system, but you'll have to watch out for the reaction today as to the quantum of the increase that has been announced in December itself. Now, it's the season of loan waivers in the country. While Madhya Pradesh and Chhattisgarh waived off loans for farmers, the Gujarat government has jumped onto the bandwagon as well, and the government has waived off power bills of rural households, farmers and small businesses worth 650 crore rupees. Over 6 lakh connections are likely to benefit from this move. Vishwanath Nair has more in this report.
The Gujarat state government on Tuesday announced an electricity bill waiver for members across the state. Now this, according to the statement produced by the Gujarat state government, about 6.22 lakh customers across Gujarat will be able to waive or get a waiver on their electricity bill, and this is going to cost the state about 650 crore. What the state also said is that customers will have to pay about 500 rupees upfront, after which their entire bill amount as well as any penalties levied on them will be completely waived off. Customers who have also lost their electricity connections because of non-payment of bill can gain new connections through this scheme. What the government has said also is that this will be applicable for all bills up to December 18th, 2018, and the entire waiver scheme will last from December till February 2019. That is for about 2 months where customers can go and avail these benefits. According to the state government, this is likely to help improve cottage industries and will also help improve farm produce because of better irrigation. That is what the state government has said in a statement.
All right, let's turn now to Nikki Mirchandani, who's joining me with all the stocks that you have to watch out for in trade on account of them being in the news. Good morning, Nikki. What do you have for us today?
Sure. Topping the list is J. Kumar Infra Projects, which the company has bagged an order of around more than 1,300 crore from NHAI for the state of Delhi. PVR is second in the list. The board is going to be meeting on December 21st to consider the funds. Also, we're looking fundraising options. Also, we're looking at Lemon Tree Hotels, which has said that the company has signed a license agreement for 69-room property in Pune, which is going to be operational by March next year. NTPC is also expected to be in focus, given that the government is likely to sell 3 to 5% stake in the company via OFS route to garner a sum of between 3,500 crore to 6,000 crore. That's a FE development that we're talking about. Apart from that, it has also restored one of its unit in Uttar Pradesh, which is going to be synchronized with the grid after the boiler restoration. Apart from that, we're looking at Fortis Healthcare, where Yes Bank has sold in 2.13% stake in the counter. With this, the Yes Bank stake in the company comes down to 8.7% as compared to 10.4% that you've seen earlier. And last in our list, importantly, is Shoppers Stop, which is going to be meeting Rakesh Jhunjhunwala, Rare Enterprises, JM Financial Services and other investors today.
All right, Nikki, thanks so much for that. Let's move on now. Somit Sarkar is joining me with the big brokerage calls of the day. Good morning, Somit. What do you have for us?
Good morning, Alex. On the big brokerage calls for the day, first we have is Phillip Capital on Jubilant FoodWorks. Now, the brokerage has maintained its buy rating on the stock, but has hiked the target price on Jubilant FoodWorks to close to 1,845. Now, according to the brokerage, Jubilant FoodWorks is poised to deliver a strong third quarter of financial year 2019. Now, Phillip Capital's channel checks suggest that the same-store sales growth in the month of October and November 2018 was around 15% because of the festive season and because of the deliveries to railway stations has been gaining momentum for the company. Now, the brokerage is expecting a 24% and a 41% year-on-year growth in Jubilant FoodWorks EBITDA and net profit in the third quarter based on the strong SSG trends, reduction in loss-making late deliveries, lower fuel costs and sharp reduction seen in the Dunkin' Donuts business. Lastly, after a 20% correction from the recent peak for Jubilant FoodWorks, the brokerage believes that the stock offers a favorable risk reward to long-term investors. Second, we have is Edelweiss on Biocon. Now, the brokerage has initiated coverage on the stock with a reduced rating and a target price of around 430 rupees. Now, Biocon is the first serious Indian contender in the competitive biosimilar space. Now, the company has invested close to $600 million in the insulin and mainly on MABs, that is the monoclonal antibodies, and intends to invest an additional $800 million going forward in these two segments. Now, the market is factoring in a revenue growth of around 27% for the biosimilar segment over the next 10 years with an EBITDA margin of close to 35%, but the brokerage is expecting the revenue growth to be around 15% for the company for the next 10 years with an EBITDA margin of close to 35%, and that is because of two factors: price erosion, which will intensify since the competition will be very stiff in the MAB segment, while market share gains will be very difficult in the insulin segment as the innovator will be aggressive to defend its own market share. So these two factors could limit the company's growth going forward, says the brokerage. Lastly, the brokerage says that the expensive valuations leave no room for upside when it comes to Biocon, and the risk reward is currently unfavorable for the stock.
Thanks so much for that, Somit. Well, you've all been aware of this rift between the RBI and the Finance Ministry, but that culminating, of course, in Urjit Patel's exit and the appointment of Shaktikanta Das. Now, Manmohan Singh has commented on this, and he said that while differences are natural, the government needs to respect the autonomy and independence of the RBI. Drawing an analogy with the relationship shared between a husband and a wife, he said that it's important to bury the differences and respect each other's position to work in harmony.
Respect the autonomy and independence of the Reserve Bank. At the same time, I would say that the relation between the government and the Reserve Bank is like the husband and wife relationship. There will be hiccups. There will be differences of opinion, but ultimately these must be harmonized in a manner that the two great institutions of the government and the Reserve Bank can work in harmony with each other.
All right, so now the fate of e-pharmacies in India is under a cloud of uncertainty. Two high courts have banned the sale of medicines on the internet, citing privacy and safety concerns. The courts have also directed the central government to come up with regulations to allow e-pharmacies to operate in India. Tamanna Inamdar spoke to Dharmil Sheth of PharmEasy, an online platform for selling medicines, and also started off by asking him of the threat of consumers buying medicines using fake prescriptions. This is what he had to say.
People can actually buy medicines maybe multiple times over the same prescription over the counter, or it can be online pharmacies, and that is something even the health ministry has sort of thought over it, and there are solutions they've proposed which will require, you know, a common platform or a seamless flow of information from the doctor to the pharmacy, wherein the prescription doesn't go to the hands of the patient. Now, unfortunately, that requires a lot of technology adoption by the doctors and by the supply chain as well. Even in the U.S., where the prescription doesn't go in the hands of the patient, there is a different problem of doctor shopping. So people go out and shop for prescriptions and then they purchase medicine. So this is a very, very, you know, genuine problem, which, you know, only if we move online or bring in a lot of digital sort of technology adoption across various stakeholders, only then we'll be able to address this. Yeah. There is no other solution right now.
Mr. Shah, the other big concern, and I see as a reason for this clash between online and offline pharmacies, is the discount factor, isn't it? I mean, we've not talked about it so far, but the fact is that a lot of online companies bring in new customers saying that we'll give you up to a 15–20% discount on your bills, and people with chronic illnesses who need to reorder expensive medicines again and again are definitely want to avail of that.
See, what has already happened in the market, that the moment e-pharmacies came in the larger cities, the brick and mortar stores have started giving discounts to select customers on a repeat purchases. Yeah. So the patient has already seen the benefit of competition coming in. This will continue to happen because there is a margin of 10 and 20% between the wholesaler and retailer which manufacturer gives. Out of this 30% margin, e-pharmacies are willing to part with half of it and keep only 15%. So the norm is 15% discount e-pharmacies start giving to the patient. Now this would definitely hurt the offline stores.
All right, well, there's clearly lots to talk about over the course of the day, and you'll find all the live market action right here on Bloomberg Quint Live. There are also several stories that you should consider reading on the website bloombergquint.com. Here are just a couple of them. The NSE has received the SEBI's approval to launch weekly options on Nifty 50 index. This move will provide a hedging tool to market participants to manage their portfolio risk more effectively. And Yes Bank has recommended the Reserve Bank of India the name of its board member Brahm Dutt for the post of chairman. The seat has been vacant since Ashok Chawla resigned in November. All right, that's all we have for you in this edition of Daybreak, but all you need to know is up next, so do stay tuned. This is Bloomberg Quint.